How does a massive economy like China, with all its internal complexities and, these intense global trade tensions, manage to not just survive, but adapt and pivot? Today, we're embarking on a deep dive into the latest economic signals from Beijing to, well, try and understand their strategic approach.
That's right. Our mission for this deep dive is really to cut through the noise and uncover the maybe surprising resilience and strategic pivots of China's economy. We're going to dissect the Q4 2024 economic data, explore the key policy announcements from China's big annual political meetings, the two sessions 2025, and analyze the ongoing, often quite dramatic impact of the U.S.-China trade war.
Okay. And to do that, we've gathered a pretty comprehensive stack of material for you. We're pulling essential insights from reports like the PwC China Economic Quarterly Q4 2024 and Two Sessions 2025 report, detailed analysis from the Institute Montaigne on China's economic resilience, and some historical context from the China-United States trade war Wikipedia entry, plus critical updates on U.S. export controls on semiconductor tech. Our goal is basically to distill these sources into the most crucial nuggets for you.
So let's jump right into China's economic snapshot, because the Q4 2024 data reveals, well, a story of impressive rebound and maybe some quiet strength.
Impressive indeed. China's GDP grew a strong 5.4% year-on-year in Q4 2024. That pushed their full-year growth to a solid 5.0%. So they didn't just meet their ambitious annual target of around 5%, they actually powered past it in that final quarter. What were the unexpected drivers that made this possible?
Well, across the board, really, we saw acceleration. Industrial output, services, retail sales, they all picked up steam. Manufacturing growth notably accelerated to 6.2% in Q4. That's up from 5% in Q3. And perhaps most strikingly, IT services led the service sector with a remarkable 9.6% growth.
Wow.
Yeah, it shows some real targeted strength in key industries.
And while those sectors showed strength, it sounds like what truly underpinned China's Q4 rebound was this extraordinary surge in exports. Net exports drove a significant 30% of GDP growth. That's a share that echoes past peaks, right? When external demand was really driving their economy.
Exactly. It looks like firms were front-loading shipments, maybe ahead of the U.S. transition, and that pushed the trade surplus to nearly $1 trillion.
$1 trillion, okay.
Yeah. Total exports for 2024 were up nearly 6%, reaching close to $3.6 trillion. And what's particularly striking is how this growth was diversified. We saw strong double-digit jumps, not just to the U.S., up 15.6%, but an even larger 18.9% jump to ASEAN nations.
Right, ASEAN becoming a huge partner for them.
Absolutely. Rapidly becoming China's top regional partner.
So who's buying what? What kind of goods are we talking about?
Well, the composition of these exports is quite telling. Electromechanical products alone accounted for nearly 60% of all exports.
Okay.
So we're talking about things like electric vehicles exceeding 2 million units shipped, integrated circuits up almost 19%, and ships surging an impressive 60%.
60% for ships. That's huge.
It is. This isn't just volume. It's a clear, inexorable move into higher value-added goods.
Yet, despite that strong export performance, it sounds like there are still some lingering imbalances, some domestic weaknesses maybe. That strong export side seems to be outpacing retail sales, suggesting, well, a continued reliance on external demand to offset weaker domestic consumption.
That's a crucial point. Low inflation, hovering at just about 0.2%. And pretty tepid import growth of only 1.0%. Both signal persistent weak domestic demand. And perhaps more concerning is the Producer Price Index, the PPI, which tracks factory gate prices. It fell for 27 straight months by Q4 2024, highlighting some severe industrial price pressures.
27 months.
And more recently, in May 2025, producer prices fell 3.3% year-on-year. That marked the 39th consecutive month of decline.
Wow.
This kind of protracted deflation makes it harder for businesses to turn a profit, right?
Sure.
It discourages investment and potentially contributes to this cycle of weak demand.
And the property sector, which has been such a focus for so long, it still remains a key concern, doesn't it? I mean, while there were some late-year signs of stabilization, maybe declines in new home sales narrowing a bit, it's still very much in focus for stimulus.
Definitely. New home sales were still down nearly 4% year-on-year in May 2025. So yeah, stabilization maybe, but not a turnaround yet.
Right.
And in the credit landscape, the overall picture suggests caution too. Total new bank loans for 2024 actually fell significantly from the previous year, which signals continued weak demand from businesses and households. However, it wasn't all grim. There was a bright spot. Loans to small and micro firms actually surged at almost 15%.
Okay, so targeted support there.
Exactly, indicating some targeted government support for those smaller enterprises, yeah.
So we've looked at the current snapshot, including those, well, persistent domestic weaknesses. How is Beijing planning to tackle these issues and chart its future course? Let's turn to China's Two Sessions 2025, which sort of unveiled their strategic roadmap. What exactly are the Two Sessions for people who might not follow it closely, and why are they so critical for China's economic direction?
Sure. The two sessions basically refers to the annual meetings of China's top legislative body, the National People's Congress, and their top political advisory body. These meetings, held in March 2025, provided the clearest view we get all year of Beijing's economic priorities. They focused on balancing growth with structural reform while also laying the groundwork for the next big economic blueprint, the 15th five-year plan, which starts in 2026.
And the overall vision seemed to show a striking strategic pivot, right, towards domestic demand.
Absolutely. Consumption, boosting domestic consumption has now surpassed even new productive forces, that's Beijing's term for those future-oriented high-tech industries, as the top priority in the government work report.
Top priority, okay.
Yeah, it signals a really clear, deliberate shift towards trying to get consumer-led growth going.
That's a significant shift. So what are they actually doing to boost spending capacity for the average Chinese citizen? What are the concrete measures?
Well, they're committing to income growth, things like wage hikes and employment support. They're aiming to stabilize the property and stock markets, which obviously impacts household wealth. And they're significantly scaling up the consumer goods trade-in program, swapping old appliances or cars for new ones. They've more than doubled its funding to 300 billion RMB.
Right.
It's worth noting, too, that per capita disposable income has actually been a sustained driver of consumption already, so they're kind of building on an existing trend, trying to amplify it.
And to encourage people to actually use that money, not just save it.
Yeah.
What about strengthening the social safety net to enhance that willingness to spend?
That's key. Measures include raising the minimum wage, increasing pension benefits, expanding medical insurance coverage, things that make people feel a bit more secure. And beyond that, they're pushing initiatives to promote work-life balance, reforming the holiday system, specifically to spur service consumption. Think tourism, leisure. The snow and ice economy, for example, was noted as a kind of unique growth opportunity there.
Interesting. And emerging trends are also on their radar. What kind of new consumption areas are they targeting specifically?
Well, the plan prioritizes digital consumption, things like AI-powered products, and also this low-altitude economy.
Right. What exactly is the low-altitude economy?
Sure.
Drones and things.
Yeah, exactly. It refers to that emerging sector of drones, air taxis, related services, basically economic activity happening in lower airspace. And they're also actively promoting inbound consumption, basically drawing foreign tourists back. That saw a huge surge, over 60% in 2024, bringing in over $94 billion in total spending.
Okay, so focusing inward on consumption, but also looking outward for tourism dollars.
Precisely.
Now, beyond boosting consumption, a second cornerstone of Beijing's strategy seems to be this relentless drive for innovation, specifically in what they call new productive forces. What cutting-edge industries are they really pinpointing for technological leadership?
The 2025 government work report specifically highlights biomanufacturing, quantum technology, embodied AI and physical robots, and 6G communications as priority areas.
Ambitious goals.
Very. And to fuel this, they announced a staggering 1 trillion RMB national venture capital fund.
A trillion RMB.
Yeah, targeting seed stage and startup companies. It features long-term investment cycles, higher risk tolerance than typical funds, and support for unicorn and gazelle companies, those fast-growing, high-potential firms, is also a sort of new focus area mentioned.
And it's not just about creating brand new industries, but also integrating these new technologies into existing ones, right? That AI plus idea.
Exactly. The AI Plus initiative aims to accelerate AI integration into, say, high-tech manufacturing and equipment production. The strategy is all about blending digital tech with traditional sectors to elevate productivity and innovation across the board, not just chasing the new shiny thing, but upgrading the core too.
Got it. Okay, thirdly, they're strengthening economic foundations through structural reforms. And a big part of that sounds like a really strong signal to bolster the private sector. Is that right?
It is. This is reflected in the draft Private Economy Promotion Law. The aim is to ensure fair competition, equal access to markets, resources, government procurement for both private and foreign firms. And what's truly eye-opening here, I think, is that private firms already generate over 50% of tax revenue, 60% of GDP, and 80% of urban jobs in China.
80% of urban jobs. That's huge.
It's massive, so despite that huge contribution, this law is still seen as crucial for bolstering confidence and ensuring, or trying to ensure, a level playing field going forward.
That's a staggering contribution. And on the fiscal side, you mentioned issues with local government funding. How are they planning to rebalance things there?
Yeah, they're looking at fiscal restructuring, specifically redirecting consumption tax revenues back to local governments to bolster their fiscal capacity. This addresses that long-standing mismatch where local budgets handled like 85% of public spending in 2024, but only got about 54% of the revenue.
Okay, so trying to give them more direct resources.
Exactly. Give them more financial leeway to deliver services and maybe invest locally.
And to tackle overcapacity. That's the rat race competition phrase they used. What are the plans there? Sounds like dealing with too many companies chasing the same market, driving down prices.
Pretty much. The government work report aims to break down local protectionism, which often fuels this and these excessive price wars. They want to remove barriers to market entry and exit, making it easier for uncompetitive firms to leave, and promoting policy-driven mergers and acquisitions, sort of forcing consolidation in some sectors.
Right, streamlining industries for healthier competition.
That seems to be the goal.
Okay, the fourth theme you mentioned is reinforcing global connectivity through opening up. How are they planning to attract more foreign investment, especially given the geopolitical climate?
Well, they have a comprehensive strategy laid out, including this 2025 action plan for stabilizing foreign investment. It seeks to draw foreign capital by broadening service sector access, think telecommunications, healthcare, education, and removing restrictions on foreign investment in manufacturing. And maybe significantly, foreign invested firms will even be allowed to use domestic RMB loans for equity investments now.
That is interesting. Using local currency loans for equity.
Yeah, it's a potentially significant step to facilitate investment.
And on the trade front, it sounds like they're also looking beyond just the traditional partners like the US and EU.
Indeed, they're bolstering trade and multilateralism more broadly. Support for exporters includes expanding cross-border e-commerce, improving logistics. China is strengthening regional trade deals like the China-Asian Free Trade Area. They're also engaging with the Trans-Pacific Partnership Process, CPTPP, and of course the Belt and Road Initiative continues as a cornerstone of their global strategy.
And underpinning all of this strategy, consumption, innovation, reform, opening up is significant fiscal firepower. Just how much are we talking about here?
We're talking truly massive fiscal firepower being unleashed by Beijing. The budget deficit ratio is set to rise to 4% of GDP in 2025. That's the highest it's been in 30 years.
4% deficit, okay.
Yeah. Total government bond issuance will reach over 11 trillion RMB. That includes a significant chunk, 1.3 trillion, in these ultra-long-term special treasury bonds designed for major strategic projects.
And specific allocations.
Hundreds of billions are specifically earmarked for initiatives we talked about, like 300 billion for those consumer trade-ins, 500 billion in special sovereign bonds to recapitalize state-owned banks. It's a huge commitment of resources across the board.
Okay, let's connect this back to the bigger picture. The U.S.-China trade war. It's clearly evolved, hasn't it? It's become this high-stakes competition, especially for high-tech markets.
Absolutely. The Biden administration revised rules back in March 2024 to restrict China's access to U.S. AI chips, chip-making tools. China retaliated with its own export bans on certain semiconductor components. And then by December 2024, the U.S. imposed new export controls targeting a wider array of equipment, software, and like 140 Chinese companies specifically to further limit access to advanced semiconductors.
And then things really seem to intensify dramatically in early 2025, especially with the new U.S. administration coming in.
They really did. In April 2025, China imposed significant reciprocal tariffs on U.S. goods, 34%, I believe. In response, the U.S. escalated threats of tariffs dramatically. Proposed figures were jumping all over the place, 50%, then 104%, 84%, even 125% were floated. Real brinkmanship.
And China hit back again, didn't they? On April 13th, halting critical exports like that grain-oriented electrical steel.
That's right, a key component for power transformers, and China produces nearly half the global supply. So that was a pretty targeted and potentially disruptive move.
It sounds like a radical escalation. Things could have really spiraled.
They could have. But then, almost surprisingly, trade talks resumed on May 7th.
Just a few weeks later.
Yeah, followed by an agreement on May 12th to actually slash tariffs. By July 3rd, the U.S. lifted curbs on chip design software and ethane as this sort of fragile trade truce held.
And that truce was extended.
It was, yeah. Further extended by 90 days in August 2025. So this rapid cycle of escalation and then sudden de-escalation, it's become a really fascinating, if unpredictable, dynamic.
Now, the Institute Montaigne report highlights what they call China's incredible resilience throughout all this turmoil. What do they mean by that? How has China managed to rebound so quickly from these trade shocks?
Well, they point to China's remarkable adaptability and the flexibility of its entire supply chain. It's
Yeah.
quite something. Despite exports falling really sharply, like 17%, in January, February 2025, they rebounded 12.4% in March and maintained decent growth, 4.8% in May. And this was even with what they called a virtual shutdown of the supply chain to the United States during that peak tension in April.
How do they manage that?
Well, China's deep integration into global supply chains allows it to pivot, essentially. Find alternative routes, alternative markets, reroute components. It's shown an ability to adjust quickly.
And the report also points to deflation, those falling producer prices we mentioned, as a kind of almost a weapon in this trade war. How does that work?
Yeah, it's an interesting perspective. Constant deflation in China, especially for producer prices down almost 3% year on year in May 2025, remember, has significantly increased its industrial competitiveness. They estimate by around 32% compared to the US and 18% compared to France, just between 2023 and April 2025.
32% more competitive versus the U.S. How?
Well, simply put, lower domestic prices translate directly to more competitive export prices on the global market. Even if exchange rates don't move much, it makes Chinese goods cheaper relative to others.
Right. And where are all these competitive exports going if they're diversifying away from the U.S., as you said earlier?
China is rapidly diversifying its export markets. ASEAN, as we mentioned, has emerged as a destination pretty much equivalent to the US and EU combined in scale now.
Wow, equivalent scale already.
Yeah. And we've also seen even more significant relative rises in exports to African countries and to Russia. It's clearly a deliberate strategy to broaden their global footprint and reduce reliance on any single market, especially the U.S.
And it sounds like they're not just diversifying geographically, but also moving up the value chain within those exports. How is China managing this sort of inexorable move upmarket?
They're really concentrating exports in high value-added mechanical and electrical industries. Think lithium batteries, electric vehicles, solar panel components. Those accounted for 60% of the increase in Chinese exports since 2022.
60% of the growth from those sectors.
Yeah. And take BYD's Dolphin EV model, for instance. Its price reportedly fell to the equivalent of 6,800 euros in China, while it was selling for around 25,000 euros in Europe.
That's an incredible price difference.
It is, and it sparked a fierce price war among car makers, both domestic and international. It just illustrates their ability to produce advanced tech at extremely competitive prices driven by scale and maybe those deflationary pressures.
And beyond EVs, are there other key niches where China is becoming, well, indispensable in the global supply chain?
Absolutely. China is becoming indispensable in many critical links. From processing rare earth metals, which are vital for electronics, to building nuclear power plants, to making semiconductors.
Nuclear power plants.
Yeah, they are currently building 27 nuclear reactors. That's 46% of all new reactors under construction worldwide. And their average construction time is targeting 5 years, compared to maybe 15 years in the U.S. Scale and speed.
5 years versus 15. Okay.
And for legacy chips, those sort of workhorse chips between 10 and 28 nanometers, not the absolute cutting edge, but essential for cars, appliances, etc., China had 31% of global production capacity in 2023. That's projected to reach 40% by 2030.
40% of those essential chips.
Yeah. And look at companies like RoboSense. They make LiDAR for autonomous vehicles. They reportedly reduced their unit costs from 120,000 RMB down to just 30,200 RMB in only 4 years.
Wow.
It just showcases China's prowess in rapid, cost-effective commercialization of complex technologies.
Now, let's quickly switch gears back to the U.S. side. The trade war has obviously had significant consequences, especially for U.S. farmers. You mentioned that earlier.
They really took a hit. China, which peaked as the largest market for U.S. agricultural products, over $25 billion back in 2015, fell all the way to the fourth largest by 2019. Exports plummeted to just over $9 billion in 2018.
And who felt that the most?
Soybean farmers in particular faced the largest losses, estimated at over $9 billion. Tariffs on some agricultural goods reached as high as 100% at the peak.
So how did the U.S. respond to help its farmers cope with that loss of market access?
Well, the U.S. Department of Agriculture, the USDA, provided substantial aid, about $23 billion in direct payments to farmers. They also purchased about $2.3 billion in surplus commodities that couldn't be exported.
Did farmers manage to find other markets?
They did diversify somewhat, yeah, to
Yeah.
places like Mexico and the EU, but it didn't fully replace the lost China market. And it's worth noting, China only met about 73% of its $40 billion agricultural purchase commitment outlined in that Phase 1 trade agreement between 2020 and 2022. So the recovery wasn't complete even then.
Right. And on China's side, what was their domestic response to buffer the impact of the trade war on their own economy?
They also implemented measures. They increased the personal income tax threshold, reduced the value-added tax, VAT, leading to significant tax cuts, around 2.3 trillion RMB reported. And while industrial output did fall to a 17-year low back in May 2019, right in the thick of the trade war, the Chinese government supported the economy with infrastructure spending, consumer subsidies, interest rate cuts, and those measures helped its GDP still grow over 5%, 5.2% actually, in Q2 2025, despite that really sharp trade war escalation we talked about.
Okay, so looking ahead now, despite those recent positive signs in Q4 24 and the ambitious plans from the two sessions, persistent internal imbalances remain a key concern, right?
Yeah.
What are some of those main sticking points?
Yeah, absolutely. New home sales, as we mentioned, continue to decline year on year. Household savings are still very high, around 32% of income. People are cautious.
Still saving a lot.
Exactly, which naturally holds back consumer spending despite the government's push. And we're also seeing these intense price wars, like in the electric vehicle sector we discussed. That level of competition could potentially lead to bankruptcies for quite a few car makers down the line. It's not necessarily healthy competition at this point.
Yeah, that level of price cutting seems unsustainable. This raises an important question then. While all these ambitious policies were announced during the two sessions, how effective will their implementation actually be on the ground?
That's always the critical unknown with China, isn't it? Policy announcement versus effective execution. Our sources suggest that many of the stimulus measures, especially the infrastructure spending tied to those bonds, will likely only have a real volume impact in the latter half of 2025. It takes time to get projects going.
Okay, so a delayed effect.
Potentially. And some long-standing, maybe more difficult structural reforms, like creating universal pensions or implementing a specific nationwide property tax, those remain largely unrealized despite being discussed for years. It also seems Xi Jinping's directives, his personal focus on avoiding financial speculation and prioritizing technological innovation, have perhaps taken precedence over broader slogans like shared prosperity that were emphasized a few years ago, that could influence how reforms are actually pursued.
Interesting nuance there. So the relationship between China, the U.S., and the EU, it certainly seems to have become this complex, maybe even vicious triangle, as one source put it. How would you describe the dynamics playing out there?
Well, the U.S., especially under its current administration, has shown a tendency for, let's say, radical, sudden action, very disruptive potential. China, in turn, demonstrates this remarkable unity of political and state action. It's proven incredibly adept at adapting tactically without fundamentally changing its strategic course, which remains focused on innovation and large-scale production.
And the EU.
The EU finds itself somewhat caught in the middle, right? Trying to balance its significant economic interests with China against geopolitical pressures, particularly from the US, and its own concerns about fair competition and security. It's a difficult balancing act.
So putting this all together, what does this mean for you, our listener? As China adapts, maybe pivots tactically, but doesn't fundamentally change its core economic model, its dependence on exports remains both a structural strength and potentially a vulnerability.
Right. And its domestic policy implementation, as we discussed, faces ongoing challenges in translating top-level goals into ground-level reality effectively.
This persistent reliance on external demand, combined with those internal pressures, all happening amidst ongoing geopolitical uncertainty, well, it could continue to create global ripple effects. Things like supply chain disruptions, intense competitive pressures in key industries like EVs or solar panels.
We've just completed quite a deep dive into China's multifaceted economic landscape. We went from its surprising Q4 2024 rebound through the ambitious policy goals set during the two sessions 2025 and landed on its, frankly, incredible resilience in the face of an de-escalating trade war.
Yeah, we've seen that clear strategic pivot towards boosting domestic consumption and driving innovation, backed by some really significant fiscal measures. Yet China is still wrestling with those internal imbalances: property, deflation, savings, and the unpredictable nature of global trade tensions.
I think the big takeaway is that China is definitely adapting, often with remarkable speed and flexibility. But fundamentally, its core strategic direction seems pretty consistent. prioritizing technological innovation, large-scale industrial production, while trying to navigate this incredibly complex global environment.
Which leaves us with an important question for you to consider. How might China's continued reliance on exports, coupled with its internal economic dynamics that push for consumption, the deflationary pressures, and the potential for persistent, if fluctuating, trade tensions? How might all that shape global trade and innovation in the years to come? Something to think about.